Hey everyone, my name is Alex. Welcome to another video. After I posted these two videos in the last 2 weeks, I've got a lot of questions on, okay, how does VC do their due diligence? What kind of startup metrics or numbers are they looking into? So today I decided to make this video to walk you guys through 16 startup metrics that VCs pay attention to when it comes to evaluating startups. And just to preface, not every startup metric would be universally applicable to every startup. Each startup is its own scenarios, and I hope all these 16 metrics would familiarize you guys with the language that we're speaking and sort of the metrics that we are looking into. So let's dive in. So first and foremost, we have the TAM. TAM stands for a total addressable market that represents the market size of the problem that these founders are solving. So this is by far probably one of the most important, or if not the most important metrics that early stage investors look for. This is because basically in that stage of the business, pre-seed and seed, VCs are looking for two great things. So how big the market looks like, and if they have a quality, great founding team. So why market size? Because a lot of VCs are looking to multi hundreds of millions of exits or even billions of exits. So it is very important for these startups to tackle markets or problems with huge market size or huge demand. Otherwise, it would be very hard for them to reach these valuations. Second and third, we have annual recurring revenue and monthly recurring revenue. So these are great metrics for subscription-based businesses, B2B and B2C, mostly for B2B, and that captures the recurring revenue for these business models. A lot of growth stage investors would look into this metric called enterprise value divided by ARR or MRR and benchmark that against other public companies or other portfolios to get a good sense of what the company is valuing at. And some of the examples that you can think of that use AR, MR a lot is like Duolingo, Slack, Salesforce, Zoom. And fourth and fifth, we have the annual contract value and the total contract value. So that is very similar to the ARR, but we are looking into not subscription-based businesses, but contract-based businesses. So if you're looking into maybe cloud software agreements, if you're looking to defense, transportations, or anything that has to do with government, those businesses are done in contracts, and you would want to look into ACV and TCV instead of AR or MRR. So ACV represents the annual revenue that you could extract or generate from the contract, and TCV is an extension of ACV, where it multiplies ACV with the length of the contract. That gives you a better sense of clarity on what the backlog looks like for the company and how much kind of deferred revenue that they have on the balance sheets. So number 6, we have net dollar retention, and it measures how much revenue a cohort is generating in each period in relative to its original size. So in simpler term, let's say if I pay $100 for Zoom every single year, and next year I'm paying $120, and that means I have 120% in the net dollar retention. That means I was being upsold, Zoom is making more money for me every single year. And in contrary, I can be paying $100 for Netflix, and next year I'm downgrading to an ad support plan and I'm only paying $80. And that means the net dollar retention is 80% instead of 100%. And that's if I'm paying the same price, and that would be 100%. So this is a very, very important metric that these VCs are looking into with these platforms and products. Ideally, they want to see a percentage of this above 100%, 110, 130 would be ideal. And that means like these platforms are getting more pricing power and getting more leverage over customers, and customers really loving these products for them to be able to achieve these net dollar retention rate. And next we have the net logo retention. So net logo retention represents the same thing as net dollar retention, but it measures, instead of the dollar value, it measures the number of customers. So that means, let's say if 100 customers have signed up for my platform in 2020 and only 90 of them remained in 2021. That tells me a 90% of net logo retention, and you can't go over 100%. Obviously you can have more customers. For these two metrics, it is important to realize that they do not include the new customers that they brought in. It's a metric that focuses on retentions. So number 8, we have the AOV, which stands for average order value. And you can also think of it as like the basket size. This is a metric that is very important to certain sectors such as e-commerce, CPGs, marketplaces, or even grocery delivery, because these firms operate in very slim margins. And the really way to grow the bottom line is to increase the average order size. So when VCs are looking into these businesses, VCs are thinking if there are room for these companies or these businesses to increase average order size, and they are also wondering like how would the unit economics change in terms of gross margins and profit if the AOV were able to increase. And number 9, we're halfway there, which is the gross merchandise value, so GMV. So GMV represents the total dollar that is transacting to your platform. So let's say if your marketplace like Fiverr, Etsy, like eBay, then you would want to look into GMV rather than revenue. So GMV is a more direct, indicative metrics that tells you how much traffic your platform has and how much users use your platform, because a lot of times like when these startups are building marketplaces, the monetization or the commission features kind of roll out later as these platforms mature. So like it is really important to look into GMV as a metric to assess growth for the company. Alright, so number 10, we have probably one of the most important VC metrics of all stages is the CAC. CAC represents the customer acquisition cost, and that represents the full cost a company would spend to acquire a single customers. And that could take place in form of campaigns, paid ads, events, sponsorships, direct sales, and things like that. And it is a great way for VC to identify the capital efficiency of the company, and usually a metric that they use very often is to take the lifetime value, divide that by the customer acquisition cost, and which we're gonna touch in a bit. And before I get into that, like it's also really important that VCs pay a lot of attention to non-organic pay acquisitions. So what that means is like if I know that you can spend $1,000 on Google Ads and generate 1,500 in gross profit, and then I'm more than happy to sponsor you $1 million so you can do the same and make $1.5 million in gross profit. So this is another thing that VC pay a lot of attention to when it comes to CAC. They want to look in scalable, like ways to acquire customers in a scalable way, and they would be more confident to deploy capital for you guys to do exactly that. And moving on to the next one, 11, we have the lifetime value. Lifetime value represents the present value of the future net profit from the customers over the duration of the relationship. So there are three elements to the lifetime value. So the first one is revenue per users, usually on a per month basis. Second, we have the contribution margin per customers, which gets you from revenue to gross profit. And the third one is the average lifespan of the customers, also on a per month basis. By multiplying the gross margin, the contribution margin, and the average length of the relationship, that would get you the lifetime value of the customers. And usually VCs are looking for, like, LTV has to be higher than CAC. That's a very intuitive thinking. And also VCs are really looking for like great ratio where you can have 3 times or 4 times of lifetime value over CAC. And that would be a healthy way for business to continue to grow with a very efficient way of acquiring customers. So number 12, we have the average revenue per users, which also called the ARPU. So basically it is applied for a more different business model than the ones that you would use ARR or like ACV. It's mostly for media businesses or social media businesses for platforms. So think of it like Meta, Google, Pinterest, Snapchat, TikTok. Basically how they calculate it is by taking the total revenue divided by the total active users or total outstanding users to get a sense of like how much revenue are these platforms generating on a per user basis. So when VCs are looking into these businesses, they're looking for high growing ARPU with network effects that doesn't really prevent them from leaving the platform. And the third theme, we have the K factor. K factor is probably one of the hardest to explain. It's also like pretty interesting in my opinion. It is very much known for in the consumer network driven product businesses. So think of things like Uber, Clubhouse, Twitter. That is a great way to measure and evaluate a traction of a business. So what it means is that how much users of a product can get other people to use the product as well. So it is very common. Oh, it's also a very common measure with games as well. So numerically, it means the average number of invitations sent by each existing users multiplied by the conversion rate of invitations to new users. So let's say on a per monthly basis, you have every one person who joined the platform also got 2 person to join the platform, then that would be a K factor of 2. And it kind of spreads like a virus, and people love that because people want high K factor. That means everyone loves the product. They love it enough to like get all their friends to be on it. And when the network effect kind of forms in a really fast paced way before people drop out the platform, it reinforce the business model and create this defensive mode for the business to continue to succeed. So it's mostly referred to growth stage companies or companies who are just taking off, and K factor is a great way to do that. So number 14, we have the DAU and the MAUs, which is daily active users, monthly active users. So they represent the total users who log in or who engage with the platform on a daily and a monthly basis. People like to use DAU over MAU as a metric to measure how much of the users who actually use the platform on a daily basis, who actually loves the platform enough to use it on a daily basis. And that speaks a lot about the products. Like if you think about TikTok and Facebook or Snapchat, they have very different DAU over MAUs, and that's a very important metrics that not VC, but just like everyone used to evaluate the effectiveness or like the quality of the products. So number 15, we have the burn rate. So burn rate is what everyone talks about because burn rate is by far probably one of the most important metrics nowadays when finance or even capital is hard to access. So burn rate represents how much companies burning per month, how much cash are these companies burning per month. And for a lot of big tech, you've probably seen those layoffs. For big tech companies or even tech companies in general, the biggest overhead is actually salaries and development expenses. So like the act of doing these layoffs is a way to conserve cash and reduce burn rate as a result to extend the runway or like the lifetime of the business. So the last one, as you probably guessed it, is the runway of the businesses. So runway represents the lifetime of the startup. So usually people want to maintain it between 16 to 24 months. And it represents when you have a runway of 16 months, that means you have 16 months to raise another round, to turn cash flow positive, and to exit through acqui-hire or like acquisitions with other bigger companies. So this is very important when VCs are investing. They ask founders or ask boards, they ask your portfolio companies that how much runway do you have? What is your burn rate? And is there any way that we can extend that burn rate? Are you confident that you can raise another round before your company runs out of money? So this concludes the last of the 16 metrics that I want to cover today. Thank you so much for listening, and I hope this has been informative and educational for you guys. And if you want me to make more videos like that, please feel free to comment down below. And again, thank you so much for tuning in, and I'll see you in the next one.